Hey, what's going on, cash flow hackers? It's Chris, Life 180. I'm excited to be doing this interview. I've been doing a lot of thinking on this stuff personally lately, talking about the concepts of business credit and just ultimately how do we, for all these entrepreneurs out there that I know are kind of in the same position that I'm in, how do you segment your life from your personal life to your business life and really get your finances dialed in? And so I've got a guy who's become a friend to me, Sebastien on this call. We're going to be doing a really fun interview. I'm excited to kind of introduce him to the group because Sebastien and I have been working together. He is a licensed life insurance guy. He does a lot with the infinite banking concept. You can follow him, the approved guy on YouTube. I'll put a link down in the description below. That's awesome. But he also is the owner of a company called Business Credit 101, and he's also the director of finance for a company called OrangeFi. And what they do is and you can kind of get more into this, Sebastien, as we get into it, but they're basically like a business credit broker or business loan brokerage company. Is that about right?
Correct. Yes.
Right. Awesome. So he does a lot of stuff. He's got courses teaching how to build business credit. He's honestly, he's just amazing with this. Like anytime I have a question when it comes to anything to do with business credit or getting loans or credit cards or anything like that for the business specifically, he's kind of like the guy that I lean on. And so I thought it would be really great to get him on here, interview him, ask him questions about where to start. Ultimately, whatever we think is going to be able to add the most value to you as you're getting introduced to the concept of going down this path of starting a business, creating an LLC. I think a lot of people when they create an LLC, they feel like they automatically have this segmentation of their personal life and their business life, and right. It all just kind of happens, and that's not necessarily the case. And so. No. So I'm excited to get into this, man. So thanks for being here.
Thank you. Thanks for having me. And I appreciate the intro. And it's always a pleasure to work with you and just to build together and share stories and just work together. It's awesome.
Love it.
So I guess just to touch on like where do we start?
Yeah.
Obviously, we're talking about business ownership here, entrepreneurship, right?
Yeah, totally.
So one big mistake people do is they think they can do it as a sole proprietor. So number one, that's a no-go. Don't even go down that route. Yeah. So let's just X that out. You need to actually form a LLC or a S corp, C corp, with an EIN number. But the sole proprietorship angle is not gonna cut it. And unfortunately, I've seen people who do that, and they're making money as a sole proprietor, and then they have to form a company, and then they get an EIN, and then a bank account, and they're basically starting from square one after 3, 4, 5 years of operating as a sole proprietor. So just number one, don't do that. Make sure you're actually forming a legitimate business. Get yourself set up with your Secretary of State. Obviously, what Secretary of State, what state, there's different states that you can operate in. There's different advantages to that. I'm not going to get into that, but you want to get set up. You want to get your EIN number, and then you need to get your business checking account, right? Don't operate, your business using your personal. And these are like little things that you think are just like automatically, just I have a business, I'm going to get a business checking account. But you'd be surprised how many people are not operating with a business checking account, though they have a legitimate business. And so when you have a business checking and money is flowing into the business, you start to record, revenue. You start to record the business's cash flow and income. And so now the bank has something to look at to say that this business is a legitimate business. Now there's about 10 data points that banks and lenders and the business credit bureaus look at, besides your structure that you have a legitimate business, besides having a business checking account. That's 2 of them, right? But there's little details that a lot of, especially home-based business owners, don't pay attention to because you don't think it matters. And the thing is, you don't need to do these things to make money, so it's not going to stop you from doing business. But if you want to position yourself so that you are attractive and considered credible, that's the word they use, called credibility, right? In the eyes of the banks and the lenders, these 10 basic data points need to be met. And simple things, right? So your business name, right? Your EIN, your business bank account, a phone number in the business, not a personal cell, but a business phone number for the business, right?
Yep.
And there's ways to save money on that. You can set up a legitimate voice over IP business line that's very affordable and have that forwarded to your cell phone.
What about getting a business cell phone line? Like actually,
that's okay as well. It's as long as it's actually a business account
in the business account,
in the business name, right?
Yep.
And then of course your email. A lot of folks just use Gmail, Yahoo, or free email accounts. Again, it doesn't stop you from doing business, but when a bank or lender looks at that, it tells them whether or not you're really a serious business owner or maybe you're treating this as a hobby, right?
Yep.
So setting up a domain name with a basic website, because now the internet and your website is your storefront, right? Yep. Very simple to do, very affordable. You don't have to go crazy. You can build your elaborate super website later, but at least have something up, right, with a contact page and that shows that you're open. Yeah, something that shows that you're open and that you're reachable and that you're legit. So that's going to be your domain name, your email account, right? There's a few things you can do to remain private, like if you want to kind of mask your identity. In other words, if you don't want the public to know who's the owner of the company, right? When you're forming the company, you can make sure that you have a registered agent, which could be either the attorney or CPA or whatever firm is helping you set up the company. A registered agent is a buffer between you and the Secretary of State or anyone trying to serve you documents. Your name is not on public record per se, and so your address is not listed. You don't have to have a business address. You can work out of your home, but it's public record.
Okay.
Right? So anyone can go to Google, put in your business address, and find your street address that you live at, see your car on Google Maps. Maybe you were outside washing the car that day, and there you are. So if you want to remain anonymous, you have a registered agent, and then when you buy your domain name, you purchase the extra $10 to make it private. Yep. It's that simple, right? Having the phone number, the email, all of these things, create that separation, that barrier, and then ultimately you want to get listed on 411 directory, and you want to then set up a DUNS number with Dun & Bradstreet.
Got it.
Right, so there's 3 major business credit bureaus. There's Dun & Bradstreet, there's Experian Business Credit Division, and then there's Equifax. Now there are others, including public records with LexisNexis.
Okay.
And there's Credit Safe, there's PayNet, but those are, I guess you could say, smaller ones that are not as important. And if you focus on the big 3, then the others will follow suit. Dun & Bradstreet is what everybody's like concerned about. Oh, I have a DUNS number. I hear that a lot. Oh, I have a DUNS number. And that's like the equivalent of telling me you have a bank account number. It's great that you have a bank account, but if you're not depositing money in the bank account, it's an empty account. It has no value, right? So a DUNS number is just an account number. It's not building your credit. Their credit score is called a Paydex score.
Paydex score.
Paydex, Paydex, Paydex score, right? To get a Paydex score, you need to have at least 3 trade lines reporting to Dun & Bradstreet.
So that's fair. So let's start there and let me ask you a couple of questions about that. So you go out, you do all the things you're talking about, you get your DUNS number, and you're the entrepreneur, business owner, and you need to get 3 trade lines. Do you have to personally guarantee those trade lines?
No, there are trade lines that you can personally guarantee, but you don't need to. There are several trade lines. In my course, I have about 12 of them that are not personally guaranteed, that will give you an account with no prior business credit so that you can establish business credit That's the hardest part, is that initial tier one, step one of building.
Yeah,
It
for
takes
sure.
about 30 to 90 days for those accounts to report to the bureaus. And
Okay.
sometimes you have to make multiple transactions on those accounts, because credit is
Yep.
nothing but a record of a transaction, right? That's all
Right.
it is, right?
Yeah.
Um, with the personal credit, it's pretty much automatic. But with the business credit, you have to be more intentional. You have to set up that DUNS profile. When it comes to Experian and Equifax, they are a little bit more automated. Once you establish an account that reports to those bureaus, then they will report and create the account for you. So you can't really go create an account with them. And then once you have an account, then you can go update that account with your information, right? Because a
Yeah.
lot of times they're going to have missing pieces of those data points we talked about.
Hmm.
They also record your business revenue, your profit margins, like they all that is on public record. And if you update that regularly, then when banks, lenders, and credit card companies and different institutions are looking at you, and if they may be looking at Experian or Equifax, it's just going to help your credit profile.
And
Um,
that's what's going to help you qualify to get the higher level credit cards as a business and the better business loans and all these different things.
Correct. So the thing about this is that it's not cookie cutter.
Yeah.
There's certain banks and lenders that may only look at Equifax. There's
Oh,
certain
really?
that ones that might only look at Experian. Some of them may be only looking at Dun and Bradstreet. Some of them may look at a mixture. So there's an overarching body that called the Small Business Financial Exchange
Yeah.
that collects data from these bureaus, and they report that data to the SBA. And then the
Okay.
SBA creates a business credit score called the SBSS score. So, if you are in business for more than a year, 2 to 2 years, and you're looking to get approved for an SBA loan, you have to have a legitimate business credit score.
Got it.
Right now, there's some business credit cards, and I'll tell you this: 99% of the business loans that are on the market, including the business credit cards, are going to require a personal guarantee, no matter what. Right, which
Yeah.
means that you can have amazing business credit, but your personal credit is still relevant and important, and you can't just
Yeah.
ignore
Yeah.
that, right? So a
Yeah.
lot of
Totally.
people are like, oh, I have business credit, but they have 550 personal credit. Like,
Yeah. Yeah.
yeah, there are loans
That's
out
not going to
there.
fly for the most part.
Sorry,
And that's not going to fly for the most part.
no, there are products that you can get approved for with really bad personal credit, but now you're
Yeah.
talking about very high interest rates and very aggressive terms. And
Totally.
if you're looking to get the better rates and the better terms, and you really want to have powerful leverage, then your personal credit, along with the business credit, along with your revenue and showing that the business is cash flowing, right, is important, right? So
Yeah.
that's another mistake business owners make. They, yes, we want to save money on taxes. We want to write
Hmm.
off as much as we can. But
Hmm.
if your goal is to expand and grow your business, and you're going to be looking for an expansion loan, you need to show that the business is profiting. You can't show that you're running in the negative or breaking even. So there has
Right.
to be a balance between the tax write-offs depending on how much revenue you're bringing in. Now, if you can write off as much as possible and still show strength and growth, then fantastic.
Yeah.
But after write-offs, if you're showing either you're just breaking even or you're in the negative,
Hmm.
that's good for your tax purposes, but you're not going to be able to qualify for that SBA loan.
It's no different for people who are entrepreneurs that want to buy a house, and they're using it personally, and they try to keep their income low, but that's going to make it so you don't qualify for a house.
Exactly. So you have to balance those parts, and just be holistic. Approach it holistically, right? Your personal credit, your business credit, your revenue, your assets. All of these things are going to come into play depending on the type of loan that you're trying to get approved for.
So let me ask you this: if you got a pretty much 99%, as you said, you have to put a personal guarantee on it anyway. What's what's the importance then of getting a business credit score, if it's got to be personally guaranteed anyway, couldn't you just show all the revenue and do business and just go get a personal loan against it anyway, which is because the risk would be really no different?
So the answer is yes, you could. But having the business credit is there's going to be some loans, like I said, like for example, even an SBA loan, that you have to have that SBSS score, right?
Okay.
So you can have all the good credit and revenue, but that score still needs to be there. There's a lot of the business credit cards require business credit, even though it's personally guaranteed, right?
Got it.
Some of them don't. Some of them, yeah. If you're starting off a new business, you have excellent credit. You're at 750 to 800 personal credit. You have good income. You can get a business credit card without having business credit, right? But there's going to be limits to the accounts that you can get access to. So if you're someone who's really aggressively trying to get access to the maximum business credit limits and lines that are available, and you're looking at getting, especially you're looking to get 0% interest promotion business credit cards, then you want to focus on building your business credit to complement the personal credit, right? And so ultimately, it's a complement to the personal credit, and the personal credit is a complement. The goal should be to be able to secure financing, whether it be credit cards, a line of credit, or a loan in the business where it's not on your personal credit at all, right? Because even though it's personally guaranteed, it's not going to show up on the personal credit.
Got it.
So now that debt on the business side, let's say you have a $20,000 credit card with a $19,000 balance on it. If that was on your personal credit, your personal credit score is going to tank because of high utilization. But on the business side, it's not going to show up on the personal.
So that's a big deal. I mean, to be able to do that, and that would be one of the big reasons that you would want to make sure you're focusing on your business credit is yes, you might have to personally guarantee it to a certain extent, but by building your business credit, you get it to the point where you don't have to have it all on your personal side of it. So it's going to insulate and protect your personal credit from a debt utilization perspective. Because I think a lot of people don't realize the impact that like the use of credit is a huge factor in what your score actually is.
It's huge.
You want to talk
it's
about
a huge
that for
factor. Oh yeah, definitely.
So
Ideally, when you are looking to apply for a loan or a line of credit or credit cards, you want to make sure that your credit card, specifically your credit cards, your utilization, not overall, but individual credit cards are under 35%, as close to 30% or less, right? Under 35% is great, right? Anything over that, your scores are going to start to go down, and then you start to show higher risk for the banks and the creditors, right? So the thing is this: there are resources available that we can tap into, and I can provide them, where you can access your 3-bureau credit report, see exactly what the banks and lenders are going to see, and you can check to see what are your scores, but what are your limits reflecting on your credit report. And here's the problem: I could pay a credit card today. Let's say I have a $20,000 card, $19,000 limit, and I'm going to go ahead and pay that down to $3,000. So I'm way under 30%, right? I could do that today. It's going to update with my credit card company within 24 hours. But there's a statement closing date, which is the date that the credit card company reports that data to the credit bureaus. That's not the due date. It's a different date. And it's not the same for every card or for every customer. So I could have 10 cards with different statement closing dates.
It's a lot to manage.
Yes. And then so I make that payment. It updates on my credit card statement. And I think I'm great. I'm gravy. My credit's, but it didn't update yet. So I go and apply for that car, for that house, for that credit card, and I get declined, or I get a higher rate, interest rate.
It's
right?
Really funny. Yeah. I'm laughing because I just went through this personally. So my wife got this new credit card, right? Like for the house, and it was not a huge balance. It had I think a $5,000 limit or something like that, right? And so she went out and was buying all sorts of stuff for the house and like whatever, and was just putting it on the credit card, and we paid it off, and so like no interest spent, no anything. But then she was like, she got a notification that her credit score went down, and she's like, what the heck? Like, why did that happen? And I was like, so, we had to have this conversation. She's like, but I paid it all off, so my credit utilization shouldn't have been, negatively impacted. And I was like, well, but you spent over and it closed, and they reported it before you paid it. And therefore, in the eyes of the credit bureau, you were utilizing 80% of the maximum credit availability on this card, and they're going to whack you for that.
Yep. It's all about timing, and it's knowing when to and how to time it, right? Yep. But the thing is, if you look at these reports, you can see the last posted payment date, or you can call the card and ask them. And if you pay your balance that you want to pay, give it at least 7 days before that statement closing date, then you will always reflect the lowest balance on your credit report. And that's what most people don't realize, and why they're wondering, why is my credit score dropping? It'll adjust next month, next closing statement, right? But for 30 days.
Unless you have the same cycle of usage.
Exactly. Then you're always going to be like, what's going on? But if you get ahead of it, give it enough time to update with the bureaus. Worst case scenario, you know what you could do? You go to the credit bureaus and you can dispute it, and they'll update it for you within 3 to 5 days. They're going to tell you, because they're required, it's going to take 30 days, but it's not like a dispute of a derogatory item. It's a balance update, so they'll update it. But you don't have to do that if you simply just time it properly and stay ahead of it. And then here's the thing, Chris. If you're not applying for any major loans, right? Yeah. A car loan, anything, right? In the interim, having high utilization is not negative. It's not derogatory.
Sure.
It's just real-time reflection of activity, of utilization.
Yeah, because your credit score is just a function of risk. So the lender knows the risk. And so if you're utilizing 80% of your credit score, but you have on-time payments and no derogatory stuff or anything, no collections, nothing like that, and then you pay that all down, your credit score is going to reflect very, very significantly, very, very quickly.
It actually could go higher than it was prior, because you're showing utilization and aggressive payback. So, like, let's say two people have the same credit profile, and let's say they had 50,000 of available credit, and one of them did not use that 50,000, or they used it very sparingly, a little bit at it. They didn't use it much. The other spent 50,000, but then paid back 50,000. Spent 50,000 again, and then paid back 50,000. That one, the scores are probably going to reflect higher because of that aggressive usage and payback.
Sure.
And that record of utilization is going to make lenders feel confident that they can lend you larger amounts, because you're spending and paying back larger amounts, versus someone who's very carefully not spending and just barely using the account. So there's something I like to call it the compound credit effect.
Okay.
All right. And this is what happens if you leverage credit cards, in particular, credit cards, properly. Yep. Right? You take advantage of the 0% interest promotion on credit cards. Mm-hmm. You take advantage of the rewards points, cashback points, travel points. You leverage the credit. Instead of spending money from your checking account using a debit card, which doesn't give you anything back, you take advantage of these 3, 4, 5% rewards points, right? Immediately pay it back so that you're always reflecting a lower balance.
Yeah.
Right? And what's going to start to happen is these credit card companies are going to see how you're using that credit, and they're going to start giving you limit increases. They're going to start giving you new 0% promotions. So now your 12-month 0% promotion is going to get renewed for another 12 months.
So why do they do that? Why? Because you would think for the credit card company, there's nothing in it for that. Because if they see they're doing that, you're functioning like that and you're utilizing it and they're paying you bonus points, are they like, that almost seems, and I'm not saying this is how it is. I'm just like, my skeptic is coming out, right? It's like, if I feel like the credit card company is trying to trap you in some way, right? They're trying to like let you do it because they know eventually a lot of people are not going to remain disciplined and they're going to fall. Like, you know what I mean? Like, why?
You know what? I agree with you. That's maybe a part of it. There's probably a large percentage of folks that don't remain disciplined with it and fall into a trap and end up, paying the fees and whatever. There are always going to be some fees. Like if you are taking advantage of 0% on a balance transfer, there might be a 2 or 3% transaction fee, right?
Yeah.
They make money there. But there's something else. It's called the interchange.
Okay, what's that?
You know what interchange is? So the interchange is the minute processing fees that occur whenever a credit card transaction is created between a merchant and a consumer.
So they're making that money. That's where American Express makes all their money. I didn't know the name for it.
It's called the interchange. So those fees they're minor, like fractions of points. But when you add up millions of people, creating hundreds of thousands of transactions, it's well, it would be billions of transactions. That by itself, they don't need to charge interest rates. That's just icing on the cake for them.
Yeah, it's like what we talk about with infinite banking. If we think about interest volume versus interest rate, that's what you're talking about there. You're talking about volume of just massive amounts of transactions.
Exactly.
So when you make little tiny amounts, that'll totally trump the rate of return.
That's right. That's it.
Or the cost of that interest rate on your credit card. So that makes sense to me for the first time ever. Thank you.
Yeah, you're welcome. So so if you leverage credit properly and you're doing it on your personal credit, and then you build up the business credit and you start getting access to business credit cards, now you have double the power. You can leverage the business credit for the business and keep that personal credit for when you need it.
Yeah.
Right?
Awesome.
And then once you get enough business credit, you can start buying assets with the business credit, like vehicles, cars.
Yep.
So here's what happens. Most business owners own or they're financing a car in their personal name. It's on their personal credit. So that's increasing your personal debt to income ratio. It's a 100% personal liability. And then we're trying to squeeze out tax deductions on mileage and gas and maintenance on the vehicle because we are using it as business owners.
Right.
If you can finance that vehicle on your business credit, and now this is somewhere now where you can get that asset, and I'm calling it an asset because a vehicle in your name personally is a liability.
Right.
Right? But in the business, it becomes an asset. Right? It depends on how you use it. But if you can finance it in the business, this is one of the few places that you can actually 100% remove the personal guarantee.
Got it.
Right? So now you can finance the vehicle 100% in the business, no personal guarantee. It's a business liability, business asset, does not show up on your personal credit. Your monthly payments to that vehicle, you're paying for a business expense. It's a business asset, right? Yep. So it's completely different versus when you own it on your personal. That's going to free up space on your personal credit. Yep. You have no more power and available credit to do more on the personal side.
I love it. That's awesome.
So that's, and with the advent of programs like Turo and different things, I have clients that have financed 2 or 3 vehicles, Teslas and Mercedes-Benz, on their business credit, no personal guarantee, and that's an income, a passive income to their business that they just use, with these resources. There's Turo, and I think there's another one. I forget. There's a new one that people are using.
Really?
Yeah.
Oh, that's interesting.
Yeah.
Well, Turo, and we've done that. I mean, my wife and I have rented our car, because we used to travel back to Vermont, so we had a Denali that we used to put up on Turo every now and then when we were out of town for like 3 months. It's like, and just let it sit in the garage.
Exactly.
And we'd rent it like probably 3 times or 4 times in that 3-month period. And it wouldn't, like, we weren't looking to make money off it, but it paid for the car payment.
It paid for the car.
It paid for the car.
That's awesome. It wipes out that expense.
So why the heck not? You know what I mean? Like, and it was literally minimal wear and tear. It was fantastic. But when you do Turo like that and you do it through a business credit, it genuinely is an asset because that car is the asset creating cash flow, and you're making a spread on the difference in the expense and the revenue created. And so from that perspective, you're creating that asset. And when you have it through business credit, when you do it personally, you're always going to be limited to a certain extent on how many cars are going to give you loans for. It's kind of like you go get a home, you get one primary home rate. Every other home after that is going to be an investment home or a secondary home, and the rates start to change. Right. When you do it through business credit, can you speak to that at all? Like the difference in rates and expectations around that, and how business can help you in that way?
So can't really speak to the rate so much. More so that as if it is generating revenue, then the business now has the ability to service that debt or more debt. So they're not going to limit you to just one or two or three vehicles. You could end up with a fleet of vehicles if you wanted to go that far. You know what I mean?
Right.
But that's awesome. Folks that are in the trucking industry, logistics, transportation, not only are you able to get business, finance the vehicles in the business, and it could be other businesses that have like big equipment, like, big printers or 3D printers or, very expensive equipment or assets to the business. All that could be bought, through the business credit. You can get, Dell, Mac, you can get $5,000 to $20,000 limits within the first 2 to 3 years. And they even have a lease program where you just lease your new device, get a $15,000, most powerful Mac that you can imagine, right? And then at the end of the lease, but it's all on the business credit. And then at the end of the lease term, you just send back the device and they give you a new one.
Nice. So let me ask you this. Somebody's starting off a business today, right? Like, let's just say today they started, they go and they follow the steps that you're talking about. How long is it until they can go out and maybe get a credit card in their business? Because I know you've done a couple videos recently. And if you want, I'll put the links to those down in the description below as well, to the videos that you just did on the credit cards that you can get with no personal guarantees or something like that. Because like if somebody wanted to say, hey, I want to go get my business credit to the level where I can start to do this stuff with no personal guarantees, how long does it take to get it set up like that if you're really diligent about doing this the right way?
So there's going to be levels to it. So if you're a startup, or even if you're an existing business, right? Because I've talked to business owners 10, 15, 20 years in business. That's how I started this, actually, because we're, helping folks with financing, talking to folks 10, 15 years in business, and they expect, well, I have all this tenure, I can get business funding with no personal guarantee. And I'm like, okay, well, let's check out your business credit. And they don't have any, or it's very superficial. They have to start at square one, just like a brand new startup. The only advantage they have is that they have the tenure of the business, the time in business, and then the revenue, where a startup has less time and they have to build up that revenue. But as far as the credit building process, it's going to be the same. All right. So it's basically going to be between, I'd say about 90 to 120 days to complete tier one, where you should have around 3 or 4 accounts reporting on all 3 of the business credit bureaus I mentioned: Experian, Equifax, and Dun & Bradstreet, right? Okay. In my course, I have about 12 accounts, and that's because some of them report to Experian, some of them report to Equifax, some of them report to Dun & Bradstreet. So collectively, you set up these 12 accounts, you're going to have the profile that you need to cover all of them. It's going to take that 90 to 120 days. Nothing you can do to speed that up. It's just the time it takes for those companies to send the data to those bureaus and for it to report and for it to show up. Now, with that in place, if you have excellent personal credit, you could probably go and apply and get approved for almost any business credit card that you wanted to, because you have the minimum credit requirements on the business side, and you have really good personal credit. There's still going to be personal guaranteed, but there are alternative business credit cards that are not necessarily your revolving credit cards that are going to give you net terms. Those net terms could be 30 days, 60 days, 90 days. Sometimes they'll give you 6 months and sometimes even up to a year. Okay. Net terms simply means that it's like a charge card, right? So you have to pay back in 30 days. But if they give you 60 days, you have to pay back in 60 days. There's actually no interest on them, right? You just have to pay it back in that time, right?
How is there no interest?
because again, they're making money on the interchange.
On the interchange. Got it. Okay.
Right.
That makes sense.
So, but they're looking at, what are they looking at? They're looking at the business credit and they're looking at the business revenue.
Well, that's kind of what American Express does, doesn't it?
It is.
I mean, yeah.
That's basically, but there's a lot more available besides American Express that can give you a lot of spending power with these net terms, and the limits can grow $20,000 to $50,000 with 30, 60, 90 days up to, like I said, maybe 6 months even in some cases, right? So when you combine these alternatives, and now those are no personal guarantee.
Okay.
Those you can get no PG because they're looking at the revenue, they're looking at the business credit. The credit cards that are more like what we're thinking of, like a revolving credit card account, that you want to have that revolving minimum monthly payment option, that's going to require that personal guarantee.
Now, these charge cards, do they offer how American Express has pretty good reward points and stuff like that to go with it? Do these other ones do the same thing?
They do. They offer rewards. They offer a lot of advantages. There's two I could just name real quick. There's one called Divvy. I'm an ambassador for them. I have a video on them. There's another one called Revenued. That's the one I think you're talking about. I'm an ambassador for them, and I have a video for them. There's a whole bunch of them. Capital on Tap. Nice. There's a whole bunch of these accounts that you can get access to, and they're not personally guaranteed.
Okay, that's awesome. So let's talk about this for a sec. So when you personally guarantee something, and I think I know the answer to this, but I want to ask it and have you say it probably more succinctly than I could. When you personally guarantee something, I go get a credit card, right? So you just mentioned charge card would be no need for a personal guarantee if your business credit is set up the right way. If you go get a credit card and it's got to be personally guaranteed, when you personally guarantee that business credit card and then the business uses a credit card, how does that impact your personal credit score?
It does not.
Does not.
It does not. Unless...
That's actually a different answer than I thought you would get.
So
I did not.
Unless you default. Unless you default. Then it reverts back to the personal guarantee.
Okay, so but if you're basically a co-signer, that's because that's what a personal guarantee is, right? Like you're basically kind of co-signing, right? Like you're guaranteeing that you're going to back it up no matter what, even if the business fails. And so on a month in, month out basis, the credit usage on that, even if it's a credit card and you're personally guaranteeing it, it doesn't
show up,
impact debt to income ratio on the personal side.
Correct. I would say 99%. There's one card out there, it's a Capital One, that will report on your personal credit. The rest of the business credit cards do not. Yeah.
So don't get that one.
It's actually okay though, because it's a starter card. So if you really needed, like if you didn't have the best personal credit and you really wanted some credit in the business name, it's a card to start with. Cool. But yeah, the for the vast majority of the business credit cards, they will not reflect on your personal credit, which means if you're maxed out on the business credit cards, you're not impacting your personal. But if it allows you on the. Oh, sorry, I don't want to cut you off. Yeah, I was just saying, if you default 30 days late, then it's going to hit your personal guarantee on your personal credit. So you don't want to do that.
Got it. Okay, so but from that perspective, like if I had a $10,000 credit card limit, right, and I'm doing like paid traffic and I'm utilizing that credit card to pay for my ad spend, and I want to get the points, and I know I'm going to spend it, or I know I'm going to spend that money anyway. Right. I'm spending money on ads no matter what. Right. And I'm thinking about very specific situations here for me. It's like if I know I'm going to spend 10 to 20 grand a month in ads, boom, done. Right. Like swipe rather than pay cash, use a charge card, build my credit, pay that back every month, get the bonus points. You know what I'm saying?
Compound credit effect. That's what's happening.
Compound credit effect, right? Yeah. And so now I'm able to do that without having a negative impact on my personal credit because I'm using that's awesome. Yeah.
And then you're getting the cash back or the rewards points, travel points. I know you travel a lot. All of your hotel accommodations, your flights could be covered by just your regular spending, And even on the personal side, for someone that maybe doesn't have that, I don't know, maybe you're just looking at this, you're not a business owner. You can still, there are rewards points and cash back and travel points on personal cards too, that you can leverage and take advantage of. If you're not a traveler, there's certain cards that are are going to give you 3 to 5% cash back when you go buy groceries. When you go to the gas station, you're going to go buy groceries. You're going to go to the gas station, right? The problem with people, and when it comes to credit cards have a bad reputation because of how they've been abused and misused, and people end up getting into big trouble, right?
Yeah.
And as we know, credit card interest rates are compounding. So
and they're high.
And it's high. It's compound interest on the credit card. So if you have a 0% interest promotion credit card and you take advantage of that 0%, get the balances down to under 30%, right? Before that promotion expires, right? Chances are you can get another 0% extension, right? Keep leveraging that 0%. Or once that 0% expires, you go get a new 0%, move the balance from that one to the new one, and keep moving to one.
Then
exactly.
Typically. Yep.
Yeah. So you can literally stick with 0% if you leverage the credit properly. Keep taking advantage of the rewards points, and look, you could buy all your Christmas presents and birthday presents on points, right? If you're not a traveler, right? If you're a traveler, you can pay for your flights and your hotel accommodations.
Well, it's just efficiency, right? It goes back to the volume versus rate conversation. And if you're able to get 2% to 4% worth of bonuses on every dollar you ever spend, now when you go to get to Christmas time, or you got to travel for work, or you got to travel for personal reasons, take the family vacation, that's all money you were going to spend anyway. But because you did it this way, and you were able to get that 2 to 4% on every dollar you ever spent, it just increases your financial efficiency on a huge way.
Yes. Is it more? Does it take more responsibility and more intentionality and more planning? Yeah, totally. But just like anything, as you start doing it, it starts to become second nature, and then you'll wonder, why did I never do this before? I should have been doing this years ago, right?
For sure.
But it becomes another revenue stream or income stream. Technically, and guess what? Those rewards points and cash and travel points, there's no taxation on that.
Yeah, that's awesome. I mean, I've read articles about a couple guys that gamed the system and got hundreds of thousands of dollars of rewards points and no taxes on it.
You don't get taxed on that. So there's another little way to really leverage. But a lot of times people think to themselves, "Oh, it's only 2%. It's only 3%. It's not that big a deal." But again, if you're doing it every day on your living, that you're going to spend out of pocket anyways, you just change the habit of using what most people do is they use a credit card when they can't afford something.
Yeah, exactly. And it can't be that.
You don't want to use it that way. No. You use the credit card when you can afford it.
Yeah, exactly.
So that you can pay it right back and leverage.
Mindset for most people.
Yeah, it's a difference between debt and leveraging.
Yeah.
Debt versus leveraging is going to give you either a return on investment or give you cash back or grow wealth. Debt is just going to take you down a rabbit hole. You don't want to go there.
But with that, I think that's where people get in trouble. So let's just talk about that really quickly, because I think it's really important. It's to leverage it to utilize it as leverage is great. But let's face it, people go through swings in life. You got to be super disciplined and be really self-aware of your current set of circumstances, right? Because I just got done doing a video before, we got on this one, right? And I was talking about the importance of saving before investing and talking about the cyclical nature of the world and the economy and everything, right? So when things are going really well and you've got your income and the revenue's coming in and whatever, and you can utilize a credit card for leverage, that's great. I think where people run into problems, and I think I'm saying this to make it so people avoid having this happen to them, is when things start to kind of take that downward swing and your revenue goes down and you can't afford as much, you have to be really aware to not keep putting the amount of money on your card that you were putting on when times are good, and manage that cash flow. Because what happened, and I've seen this in all the coaching and the stuff that I've done with people, is they're things are great, and then things weren't great. And I'm like, well, you have all this credit card debt. Oh yeah, it's because we're used to going out and putting $4,000 a month on our credit card and going to dinner and all that.
You have to adjust. Paid it off.
Right. But then Johnny lost his job, right, and we just kept going out anyway. Well, I got news for you. The habits got to change. Right. You know what I mean? We got to be Like otherwise you're going to run into problems. And I think
100%.
it's easy to kind of like lose touch with that because you still have the card. Like nothing feels different, right? And emotionally we just kind of want to.
Right. That's the danger. That's the danger.
Yeah, that is the danger. So just be very, very aware of that.
Yes.
You know what I mean? Like, because that's huge. So one last question before we go. It's been on the top of my mind since you brought it up. Credit score for your business. What did you say it was called again?
So Dun & Bradstreet is Paydex. It's called the Paydex score. It's from 0 to 100.
Okay, so that was my question. So we're used to talking personal credit scores, like anything between like 620 and up, you can kind of get a mortgage. Anything above 7 to 720, 740 is like okay. 740, 760 and up is really good, right? Like, so I think most people are thinking about it in those terms. Like, so can you explain the difference in how business credit works from a number perspective?
Sure. So first, Dun & Bradstreet's Paydex score is 0 to 100.
Okay.
Equifax, it's called the Intelli score. And that's from 0 to 100 as well. I'm sorry, that's Experian. Experian is the Intelli score. Okay. Equifax is a risk score. That's what they call it. And that's from 0. There's two of them. There's one from 0 to 100 and then one from 0 to 900, right?
Okay.
But you just focus on the 0 to 100. And ultimately, you want your score on all three of them to be 90 and above, right?
Okay.
So your first round of building credit, if you do it properly, you should hit around 80 to 90. And then as you continue to, manage the debt, you should hit 90 or higher.
Okay.
What determines that is going to be how fast you pay the bill. So that's the thing about the business credit. It's not even about paying it in full, but it's how fast do you pay it, right?
So I swipe the card on the charge card to pay for ads, and then next day pay it off?
Pay it off.
Really?
Don't wait. See, with personal credit, you could wait to the last minute.
Got it.
You can even pay late, and it's not going to affect your credit. Like up to 30 days late,
it
still won't hit your credit.
It's not going to have a negative impact.
You're going to have a late fee.
Yeah.
But it won't actually hit your credit. With the business credit, you're not going to see like a ding. Like it doesn't say, oh, you're late or anything. But what happens is just think of it like this. Every day that you don't pay, you lose a point.
Got it.
You got it? Okay, so they reward you for fast, prompt payment.
So if I'm doing that, then let's break down. Give me a little personal coaching here. Okay. So like I'm spending $700 a day on ads, right? And I put it on this card. Do I send in $700 a day to the charge card?
Yeah. You could just do like $400 a day to the charge card.
Something like that, and then do a lump sum at the end of the month kind of thing.
Right. So because all you're showing is that you're on top of it. You're paying it immediately. Okay. So if you're doing that, if you're doing it like daily, like the next day, you're going to end up with like a 98, 99 score because you're literally like, there's no delay, right? Okay. Now, the thing to also note is if it is a net 30 account or a net 60 or net 90, you have to make sure you pay the invoice on the account. Okay. So depending on, especially when you're building credit, when you're first starting, some of the accounts you're going to set up are going to be accounts with stores or with vendors. Okay. So they'll give you, and that vendor sells stuff, maybe office supplies, or vendor sells gas even. There's gas cards too.
Yeah.
So when you process that payment, if you just go pay it, but you don't pay the invoice, they're not going to report that transaction to the bureau. You have to wait for the invoice. And especially when you first start, it might take a day or 2 or 3 for the invoice to come. And I had a client once, even though I told him exactly what I'm telling you, a month later, his score was like a 50. And he's like, why? I was like, well, you paid it like 40 days late. He's like, well, the invoice didn't come in the mail till 30 days later. I said, but I told you to pay it the next day. He's like, well, I didn't see it, so I figured I'd just wait for it to come. No. You have to be proactive. You got to call the company and say, hey, I don't see the invoice. Help me out here. I want to pay it right away, and then they'll help you to do it. Don't sit back and just treat it nonchalantly. It does require more intention and more just staying on top of that. But it's worth it in the end. If you can do that, it's so worth it.
For sure. And I mean, at the end of the day, like you build the company big enough, you hire somebody that can help manage that side of things for you.
Yeah. Yeah. And another thing you do is you can use some of these spending accounts as the account to pay your other accounts.
Mm.
So this is one of the strategies in building business credit. I have you set up an account, a spending account, which it reports to the bureaus, right? And then now you have a net 30 term on this account. You use this account to pay your other business credit accounts.
Oh.
It just last thing I want to say is also you want to look at all of your utilities as a new business owner, or even as an established business owner. Look around in your business and your personal life. What can you transfer to the business?
Got it.
Can you make that light bill a business expense? Call the light phone company. Call the light electric company, right? If you have a gas bill, can you make that a business expense? If you have anything that you pay right now, if there's a way to transfer that to the business, make it a business expense, do that.
Got it.
Right?
Okay.
Now, they might not report it to the business credit bureaus, but there is a business credit service called eCredible.
Okay.
And what they do, first you pay them like $10 a month as a membership, and they report that to Dun & Bradstreet, just your membership. But then they search public records for any utilities. It could be a phone bill, light bill, any of these things we're talking about.
Like your cell phone bill, for instance.
Cell phone, because that's not going to report. But if it's in the business name, they're going to detect it and they're going to report it to Equifax.
Got it.
Which is very helpful because there's not a lot that reports to Equifax. Yep. So that's another thing you can do. I had a client tell me, well, I don't have much. I told him, go look at the light, look at the phone, came back 2-3 months later. He had 6 accounts reporting to Equifax that he didn't think he could, but again, it just took a little bit of brainstorming to, and now those are business expenses, which are additional tax write-offs to the business.
Love it. That's amazing. Well, man, that's a lot to chew on. So I think we gave a ton of value in this. If anybody is watching this and they have any questions about anything to do with business credit, I know you have some master classes and stuff like that. So what I'll do, guys, is I'll get the links from Sebastien. If you want to go deeper down this rabbit hole and learn how to do everything he's talking about, I'm going to share the links down below for all of his different content. I'm going to put the link to his YouTube channel if you want to get more content about this kind of stuff. And is there anything else I'm missing?
No, just want to, I guess, just touch on, I guess, just overall business financing.
Okay.
And
yeah. Yeah. Totally.
And just kind of mention, there's a lot of funding options out there, and even with what's going on, in the economy, the banks are right now, they're trying to save the day. So there's incentives. The SBA has waived all of their fees to the banks for SBA loans, right? So the banks they're trying to incentivize the banks to get money out there to business owners, because if they can do that, it's us small business owners that are really the backbone of society, of our whole economy. So if we can get financing for our businesses to grow the business, to hire more employees, create more jobs, this is what it's all about. And so right now there is funding available. I know, like, for example, in the real estate space, a lot of mortgage lenders are freaking out, and people in the real estate industry are freaking out. But right now in the business finance space, I have to say it's very exciting because the banks are putting money out there. They want to lend. So unless there's another shutdown, I don't think the banks are going to stop lending to businesses. Businesses.
I guess time will tell. But and guys, just so you know, like, Sebastien is a wealth of knowledge, as you've seen in this, with all that stuff. Like I said, he's the director of finance with OrangeFi, which does the business lending stuff. He's got the business credit 101 stuff. And so no matter, I would say, no matter where you are on the spectrum of, like, business owner looking to get any of this done for yourself, I would reach out to him and connect with him and learn more from him. And I'll put all the links to do that down below. So, and if you have any comments, questions, or whatever, and you just kind of want to put them in the comment section, go ahead. I check them all the time. I'll let Sebastien know, and he'll probably check them all the time as well, just to see if there's anything relevant to respond to. And that's it. So make sure, if you haven't already, subscribe, hit the bell, that way you're notified every time we launch a new video. Go check out Sebastian's channel, subscribe, follow him as well. And that's it, man. Hey, thanks so much for being here. This is so much fun.
Thank you. Thanks for having me.
I wanted to interview for a long time, so I'm glad we finally got this in. So guys, have a blessed, inspirational day. We will see you on the next video. Take care.